In fact, I'm going to describe this crisis as the most orderly crisis I've seen in my lifetime. That sounds like a strange, an oxymoron, orderly crisis, but let me explain what I mean. In any crisis, markets become a pricing game. And what are you talking about? There are two words in finance we use interchangeably, value and price, that we should know. We know what drives the value of a company, an asset, a stock. It's driven by cash flows, growth, and risk. And if you've done a discounted cash flow model, you've essentially used these tools to value a company. So value is driven by fundamentals. You know what drives price? It's demand and supply. Now, is demand and supply affected by fundamentals? Obviously. Cash flows, growth, and risk play a role, but demand and supply is also affected by mood and momentum. So when you think about markets during a crisis, markets become a pricing game. What that means is the mood can shift, the momentum can shift. And you can see this play out when you look at markets, especially over the last few months. In fact, as you think about the difference between value and price, there are three contrasts you can draw between value and price. The first is value as an upper bound and a lower bound. Sounds abstract, but let me explain. One of the companies I valued repeatedly on my blog is Tesla, a company I like to value, a fascinating company. Let's say you're an optimist on Tesla and I'm a pessimist on Tesla. As an optimist on Tesla, you might say, I think Tesla is going to have 500 billion in revenues by year 10, making it much, much bigger than Volkswagen, have margins like a tech company, and be able to reinvest like a tech company as well. And you could come up with a value of $2,000 per share for Tesla. But there's an upper bound. Even the most optimistic person can put only so much in revenue, so much in margins. Value as an upper bound. So if you ask me to classify investing, and this is something I've been thinking about for a long time, I don't classify investors into smart and stupid investors. I classify them into humble and arrogant investors. Humble investors, when they win, know that a big reason for winning is being in the right place at the right time. They got lucky. If they lose, they look at themselves and say, what did I do wrong? Arrogant investors, when they win, will tell you it's because of their great skills, their stock picking. If they lose, it's always somebody else's fault. If you talk to somebody, especially a hedge fund manager, and the hedge fund manager says, I can beat the market, I have the perfect system, walk out of that room. That is arrogant money.